I'm still trying out, their summary process, summary AI, and they have other features as well. I'm just still playing with it, getting to know how Zoom can help us create a more interactive webinar. But so far, they have been able to create a full summary on our 1 hour webinars. And I have posted that, including all the presentation deck. And sometimes we go through valuation and including the Excel valuation sheet as well. I'll post it on our members page so you can download it and view it at your own timing. Let me start by sharing the page and we can... Give me a minute and I can... Okay, and today, instead of looking at each individual companies like we have done in the past few weeks, this time around, I'm just going to share a little bit of my thoughts on what I found out more about China. I just came back from a trip from China with my family. We went to Shanghai for a short trip. But when I was there, I was also checking out, how dire is the situation of the property market, how's the consumer demand right now, and how's the tourism like. Albeit we are going at a low peak season, so of course there's not much tourists there. But also just give you some of my thoughts, including we went to visit Raffles City, Shanghai as well. I'll give you a little bit of my thoughts on that, and hopefully then we can come to some conclusion at the end of this presentation on what I think could be the risk and opportunity right now in China, including some of the stocks that I think would make more sense if you're still looking to invest in China right now. So as it is US election period with Super Tuesday to yesterday, and let's look at if China can be great again, right? So this is just a quick introduction to our Premium Club. But what we're going to discuss today is my takes away from the short trip to Shanghai in China, and also a scenario analysis on what could happen. How would a crash look like? How would a recovery look like? And whether we can still invest in China, and some of the key stocks that I think would benefit us. And lastly, with our spin-off section with a little giveaway at the end. Okay, so China right now, the biggest issue I think everyone is talking about and everyone knows about is the property sector, right? The cool down of the property sector is not a joke. It has a real impact on the entire economy and could bring down the entire economy if the Chinese government, I think, if they don't handle it properly. I have heard, just by speaking with the locals there, the situation is not good. The situation is no good, and a lot of people is actually facing negative equity in the house. So, for example, maybe they have bought the property with 80% loan. And just in 2022 and 2023, the index itself, property prices has dropped 20%. So about 10% each year. And that's just the average, right? So there could be property that has dropped even more. And these people that would still be financing the house, but the equity is completely wiped out. And there are many people facing such an issue. So this is a key problem. But China has not risen any of their interest rates. So, with people, if they're still employed, maybe they would still be able to maintain the property. Not too big of an issue, but if it comes a day, if the economy is not doing that well, some people might lose their job, and we'll see default happening, default rates increasing very, very significantly. That could have a huge impact across the entire country. Right now, it's a huge problem, but I would say it haven't reached the point where it's a major meltdown, right? Things do look moody, I feel, in the property sector and across China as a whole. But it hasn't reached a stage where it's a complete meltdown, I would say. And there's still some hope maybe that this situation can be salvaged. Okay, so my short trip to Shanghai is actually just bringing my kids around. So a lot of the things we went to the touristy areas, have a look around, go to Disneyland. But in Shanghai itself, when we are staying there, what struck me as quite interesting, although it's a low period for tourists, is that there are hardly any tourists around, and it just caught me a little bit off guard, especially when we're in a big city like Shanghai. And most of the places where I visit are touristy areas also. So, but most of them, I would say 99% of the people that I bump into or observe are mainly locals. And I think, I don't know if it's just this period of time or there's really very, very low demand of tourists in China right now. And it seems that the Chinese people, especially those service people, it seems that their usual habit is to serve Chinese tourists, Chinese domestic tourists as well. Because we came across a few shops where we're trying to buy something with our Master or Visa card. The personnel has a lot of, it seems that they are very confused on how to switch the machine to accept international cards. And that kind of make me a little bit surprised, and it seems to me that at the maybe many of them still rely on mostly domestic tourism. And in the end, we have to use, we have to pay through, their own payment method like Alipay or mainly Alipay throughout my trip. So that seems to be something interesting that they are, even for a big city like Shanghai, it's still predominantly a lot of domestic demand rather than looking outwards on focusing on attracting foreign tourism or foreigners. So that's something a little bit interesting. But overall, the city, I would say, reminds me a lot of Singapore, actually. Very good infrastructure, very good transportation, feel very safe in Shanghai. Talk to a few of the Uber drivers, like their Didi drivers. All of them mentioned that the safety in Shanghai is top notch, no issue at all. So overall, it feels a little bit like Singapore, just generally maybe slightly cheaper, but also not that cheap. So I give you a sense. One night I was in the hotel room and I was just browsing through their CCTV, which is their channel, but on the finance channel, and they're talking about jobs, and the program was just saying that there are a few jobs expo around in the city, ask people to go and visit them to get job opportunity. And they specify that the job range, salary range could be anywhere from 5,000 yuan to even 20,000 yuan. And that figure seems to me by the announcer that 20,000 yen is a very, very big sum for a salary sum in China. But if you convert that, to Sing dollar, it's actually not that much, right? That's roughly range less than 1,000 Sing to about 4,000 Sing dollar, which is like a fresh grad salary in Singapore. So, but at the same time, the spending is actually quite on par with Singapore, especially if you go to the touristy area, right? I'm sure you can find much cheaper food. The cheapest food that we end up having is, just a neighborhood shops I wouldn't say neighborhood, but just along the city, a small shop, we just have a bowl of noodle and it costs roughly 20 renminbi. I'm sure you can find even cheaper food in some other areas. But that's the cheapest that I experienced throughout the trip. And all the food, say within shopping malls or in proper restaurants, I would say the price range is quite similar to Singapore. So actually, the standard of living in Shanghai is quite high. And it should be quite painful for most people to enjoy the city in totality lah, given the spending the pricing range of the spending in the city. And also an observation for me when I'm just interacting with the service staff, maybe it's just my opinion. Of course, this one is just my opinion. It seems that, you know, I wouldn't say that their service is in particularly great. They're not bad also, but you know, it's not extremely good like maybe in Japan or even in Thailand. Generally still okay, but it gives me the sense that a lot of the way that they handle their service quality, a lot of them feels a little bit I get jaded, or you know, just feel a little bit restless when they're doing their job. Maybe because of the economy, or it's just the way they are. That one I'm not sure, but it just give me a sense that they're very reluctant in their service. So that's a quick, I guess, experience on my takeaway during the short week that I'm there. But on the flip side, I found that, you know, although it feels a little bit muted and not as busy as I think Shanghai would be, but there's a few things that stood out to me. Number one is almost every single shops or even baskets. We were just outside of Disneyland, and it was raining, and there's a lot of baskets out there trying to sell us a raincoat or other things. You know, and it's raining heavily, so we really end up buying the raincoat from them. Even, you know, just people standing on the street trying to a street hawker, they have QR code and ask me to pay through their Alipay or WeChat Pay. Everywhere around, in every shops every restaurant they go to, they would usually want us to order by ourselves through the QR code as well. But the QR is not like ours where we just scan with our camera and goes to a portal. It must be scanned through either a WeChat or Alipay, and or using their Meituan app. So especially WeChat, they will have app. The QR code is a little bit unique, as in it's circular, while the others would be the normal squarish type of QR code. And that's something I think stood out for me, that almost every single shops is linked to this tech giant. Mainly these three: Meituan, Alipay, and also WeChat on all their services and payment. They still go through them. That's pretty interesting to me. And another thing is, in every restaurant or every F&B area, they have this phone charger rental. And I see many of the locals are using it, especially at the end of the day, you know, when we're having dinner time. And it kind of again signify, you know, the importance of the mobile for them. Without the mobile, I think it's very hard for them to operate in any capacity in the city. Their wallet, the app, they're just ordering menu, everything is done through the phone. So they need their phone to be 24 hours on charge. So that's something interesting as well. So I think in China, they are really facing a huge problem and mainly stem from the property sector. I don't think this will go away anytime soon. It will either slowly fade out and take a few years, or they could have a big crash and then they have to recover from it. But either way, it will take some time, and I don't think we're anywhere near the crisis point at the moment. So generally, I would say I would still be very, very cautious if we want to invest in China. I myself has been looking at a few companies. Previously, our last webinar where we talked about Li Ning and Anta, these are also Chinese stocks that are interesting to me. And I have also been thinking of topping up my investment in the big tech like Alibaba, Tencent, Meituan, or even looking at Pinduoduo. But I will still be a little bit more concerned with how the short term might have some risk, right? If there is a huge crash in the property market that spill over to the banking sector in a big way, then I guess the entire stock market will crash regardless of whatever stocks there is. Of course, they can recover, but the good stock will recover, but it might take a while, right? But I also found out that regardless of whether there is a crash or what, I think the tech giant especially has now become a necessity in the Chinese society, right? It's no longer something that just because if the economy is bad, people will forego the services of this tech giant. They have been integrated so much so into the society that it has really become a necessity for the society to function, right? The society cannot really function without companies like Alipay or WeChat or even Meituan, especially for the F&B segment. So the demand coming from this tech giant, I think, should be quite inelastic to the economy, how regardless of how the economy does. So that's a quick takeaway that I have about them. If you have any question, about what we discussed, feel free to open up your chat and type in there. Later on, I'll look through them and we can have a Q&A right at the end. If you are using your mobile, just click on the 3-dot icon and then you should be able to find the chat button. Or if you're using the desktop, at the bottom of your screen, the panel, you should also be able to see this chat function as well, right? Okay, but from that just short experience that I have, and from the past few years of learning about China, I think right now some of the safest stock for us to look at in the Chinese stock market would be coming from two categories: the big tech that is already ingrained into the society, your Alipay, your Alibaba, your Tencent, your Meituan, your Pinduoduo, your JD. Those will be the ones that I think would be relatively still okay to look into. And another one interesting to me is actually their telcos, because their telcos provide the fundamental infrastructure for all these tech giants to provide their services and to allow the entire nation to function, right? And they only have 3 telcos, and all of them have more or less invested into the 5G upgrades, and their dividend rate is actually pretty high right now, and I can show it to you guys later on. All right, but let's go each section by each section. So the first one, the big tech, I'll just show you how low of a valuation that they are at right now. So if you're looking at Alibaba, it's trading at roughly about 13 times PE right now. And when you look at its past record, it's still growing. right? Still growing pretty strong. The last ROE last year is about 10%, and Tencent's also around that area, about 12 times PE, also growing still reasonably well, and has a ROE about 25.5%. Although 13 and 12, you might feel maybe it's just a reasonable valuation, but actually for this tech company, it's a very, very, very low valuation. They have been trading close to 30 times for most of their life. And this valuation right now is almost one of the lowest that they have been trading on. Meituan, on the other hand, actually Meituan only just turned profitable in the last 12 months. So you will see that their PE is actually a little bit high, but that's mainly that they only just turned profitable. Their ROE is about 6%. So if you assume that they can also boost up their ROE a little bit, maybe in between these two companies, they should be trading at about around 20 times their PE, their potential PE in the future. So still quite reasonable overall. We can also just take a look. Let me just run through their financials. Let me see if I can make this bigger. Okay, I can. So I'll share with you this one. Oops. Okay, here you go. This is just a quick snapshot, but you can see that their revenue is actually still growing 700, 800, 900 this year. Operating income is also been increasing, which is good sign, right? You want the operating to increase together with the revenue. So they are maintaining their margins. The business is doing better. Net income is more fluctuating, mainly because they have a lot of revaluation based on their investment. So I would generally not look at that and just look at operating income, which is all pretty good. And I'm quite happy with it. Of course, the company, strong balance sheet, no debt. I mean net cash, and also cash flow wise is always been a positive free cash flow. Right? If you look at the valuation for Alibaba, there you go. You can see that in the past 50, the 2015, 20, but it has always stayed around 20 to 50 times earnings, their earnings, and right now it's about 13 times, recovered slightly from 2013. But compared to their average, it's almost half of the average, and that's true for also Tencent, and even true for Meituan as well. So all these I find that pretty interesting value right now. Not to say that they cannot go down even further. But at this current moment, I would say that if you're looking at China and you want the safest stock possible at good valuation, this will be the one that I am would be considering, right? How do I go to the next one? Okay, and as our last few webinars also, I like to just do a quick SWOT analysis on this company that we talk about. I'll do one for the big tech right now. Later on, I'll do one for the telco as well. But just just roughly scanning through them, some of the key strength is they are already a very trusted brand and ingrained into the economy, and they are some of the companies with the best technology and the best talent to work for them within China. So that's definitely their strength. But the key weaknesses and threat that they face is always coming down to government control, right? How big the government allow them to grow, that's something that could be a topic that will face them. And we've seen the government trying to clamp down on their anti-monopoly practices as well already. And they might want to control the size of this company growing too big. Because to the Chinese government, I think if we see it from their point of view, they still want to maintain that they are the biggest entity in China, right? What's happening in the US is that companies has become so big that sometimes actually in the US, the country is being run by the companies, right? They have so much resources for lobbying to change the policy of the government, and they can have the money to elect to push the government official that they want to be elected. So a lot of times behind the scene, those running the country in the US is actually the companies and the corporates. And so I think from the Chinese government standpoint, they want to avoid that. And a key way to avoid that is to ensure that all these companies would not grow to too big that the government no longer be able to control. So that could be a ceiling for us as investors to this company. There might also be threat to profit control, right? If this company would be seen as just utility for the nation, and it is a necessity that for everyone to use for the country to function, then the government might put a cap on their profitability, right, to ensure that they have a fair pricing to the consumer or the small businesses using them, and that might decrease their profitability in the future. So these are something that we have to consider. But the opportunity, on the other hand, is that, like I said, I still feel that China is very, very domestically focused, at least on these areas for the big tech. And if they are able to somehow attract either more tourists coming to China, or they have a way to expand their technology overseas to other big markets, then it could be a potential for them. If not, they'll reach a point where they no longer have much interesting place to reinvest, and grow the company. And when it comes to that, then maybe all these big tech would become the future dividend stocks for us. And that could also be an interesting prospect because of their huge cash pile and their huge cash flow generation. It could become a very, very good dividend stocks in the future, right? And of course, looking through this big tech on our moat rating, if this is the first time that you're coming to our webinars, I do this thing where just reviewing some of the key price moat that they have, different factors that a company can create moat, and look through them to see how well and how big of a moat this company has. And I think at least for the big tech, when we're talking about Alibaba or Tencent or even Meituan, they are some of the best companies in China. I would feel I will give it a 4-star on their moat rating, that they're able to control their margin both on their customer side and their supplier side. But one of the supplier, of course, is the government, and that's a key point that I don't think they have any pricing power over that, and so they are a little bit shy of 5-star business. But 4-star still, I would say, one of the best if you're looking at Chinese businesses. The next one is a group of company, which is the telco, and they have 3 big telco, and the biggest one of them, of course, is China Mobile, which is Zhongguo Yidong. And this one right now, I think, is a 1.5 trillion market cap company, while the rest are in the range of 300 to 500 billion Hong Kong dollar company. So you can see it's actually quite a big difference between China Mobile and the other two, right? The big guy and the 2 other smaller guys. But all of them are high dividend paying companies right now. China Mobile give about 6.8% dividend. China Telecom about 6% dividend. China Unicom is about 6.1% dividend. So as a dividend stocks, I think pretty good. And if you're just looking for some passive income, if you don't mind that, if you don't look at their share price and just want to focus on the dividends, I think these three companies provide some good, stable dividends for the long term. But in terms of share price, maybe a little bit muted, right? I can let you see just how their stock price has performed over the past few years, apart from China Mobile, right? Apart from China Mobile, you can see that China Mobile over the long, if you say after.com, at least the stock price has 4 times from the bottom after the .com bubble. But in the last 20 years, I would say hasn't moved much. And this is quite the same for both the other two. In the last 20 years, hasn't moved much. So you're just looking at the dividend that they're giving. But the good thing is their dividend actually is growing as well. Let me see if I can load this up for you. And you can see this is from 2014. So the dividend per share fluctuating, but increasing to the current 4 plus. During COVID, they have decreased their dividend, but if you take out COVID period, dividend has roughly stayed pretty in line over the last decade or so. So interesting company to look at. As a whole, I would say their strength is they are a key necessity that should just earn a reasonable profit as a telco. But some of the weakness that they might have is just lack of area to invest. We've seen that in the US telco, where many of them has went out to buy tech companies like Yahoo or buy media company. So I think the Chinese telco might not do that, but it might reach a point where after they invest in 5G, 6G, or all that they can spend on the new generation of telecommunication technology, there might be a plateau to where they can invest. So that's something for us to ponder. But overall, the moat rating, I think I'll give it a 3, given that they are basically a oligopoly in the industry. But we should also talk a little bit about what is the potential of how wrong the Chinese economy could go. For myself, right now, my Chinese portfolio exposure, I will say that it's just around 20 to 30% of my entire portfolio. With the predominantly, I'm still invested in the US for over the past decade. And I have no plans to make China as my main portfolio, right? So even if I feel that Chinese stocks are very undervalued, or I don't think that even if I feel that maybe the crash is not going to be that big of an issue, I would still not put more than maybe 40% of my portfolio into the Chinese stock market. And one key reason is I see a lot of resemblance of what's going on in China with what's going on in Japan in the 1990s. And basically, what they did is they just try to go against the biggest guy in the world, right? They try to go against the US. So I think the Chinese, for the past 2 decades, their strategy has always been to stay low profile and grow slowly, not to awaken the giant, which is the US. That has been the strategy for Japan until the late 80s, where they become so obvious that they're becoming a threat to the US. that the US turn around and put many sanctions and trade tariff into Japan, try to derail their currency and basically destroy the lead to, I wouldn't say that they destroy, but it lead to the destruction of the Japanese economy for a long time, right? Until recently, where they slightly is more attractive to investors. I think that could happen to China as well, given that now they are already in the crosshair of US, and the US have done this a lot of time. The US know how to control adversary, and they have a disadvantage. They has a key advantage over everyone else, given that the US dollar is the reserve currency for the world, and they can use it to their advantage. And the Chinese yuan is nowhere near going to replace the US dollar anytime soon, regardless of what the media want to talk about, right? If today China is really going to open up the renminbi and let it be an open market, I am pretty sure there's more Chinese people who want to move money out of China than more people who want to turn to buy renminbi and treat it as the next US dollar, right? And it will lead to a huge currency crash for the country. So they're not going to do that. And if they're not going to do that, then they don't really have any tools to fight back on what the US is trying to push on them. But they have one key advantage over Japan, which is their domestic consumption. So China has the potential to create a domestic consumption that is enough to sustain themselves and to grow the economy, right? Japan wouldn't have, Japan population is just 100+ million. Even if the Japanese spend like how a US person will spend, they still nowhere near to create the domestic consumption and economy that they can do. But China, on the other hand, could be different. And just looking at the luxury sales right now, just looking at apart from the property sector, I think Chinese people would still have the spending power and ability to recover their economy if it comes to a point where they have to rely on themselves. So that's one key advantage I feel that they have. Whether or not they can fully utilize it, or the Chinese economy and the Chinese government can boost their earning potential up so much until they have disposable income to spend. And how long that is going to take, still a question. But definitely they have the potential. So that's something to I'm thinking about. So far, I would say for them to completely repeat a Japan-like crash and see a stock market or economy that don't grow for 2 decades, chance is low, but it could happen. It could still happen, right? So that's roughly what I want to share with you guys for this time around. And I think if it still comes down to yourself, right? Because we want to buy stocks that we are comfortable with, and we wouldn't be we will still able to sleep soundly at night once we buy these stocks. If you're by yourself, you still adhere to the Chinese story, that you still feel that the Chinese market can potentially become as big of a market as the US, or even take over the economy of the US, then I would say that we should still be investing in China. And at this moment of time, because it's very volatile in the Chinese market, I would say still stick to more safer stocks. And some of the stocks that I talk about, I think are some of the safer stocks that I can find for you. But if you're someone that is very wary of the Chinese economy, of information coming out from China, then maybe it's still fine for you to completely disregard this market at all, right? And that's roughly the part on China that I wanted to share with you. Before I go to the Q&A, right now, if you have any questions, either from some of the stocks or question about China in particular, or maybe US as well, doesn't matter. Just feel free to type in on the Q&A, and I'll get to the Q&A in just a minute. But I just want to highlight to you, actually, I'm trying to do this every month, which is having a giveaway on books that I find interesting. And this month, I have talked a little bit about this book, the new book on Elon Musk by Walter Isaacson. And it's a fascinating book, and really, when we are following the stocks of Tesla or things we read on the media, the behind the scenes of what he's enduring and what he's going through really comes out in this book. And I think it gave me a new perspective about him and about what he really created over the past few decades. So very interesting. And all I hope that you can do in return for me is share a little bit of your takeaway on your own social media, either Instagram or Facebook, or on your feed, to share with your friends, to let them know, some of the key takeaway that you have learned from our webinars or from our VIA club. Give me a little bit testimonial, if possible, if you have enjoyed being with us. And while you do that, please tag me so that I will be notified that you have posted it. You can tag me either on my personal account here, Stanley Lim PS, or the Learn with Stanley account. Either way, so that I would be notified that you have posted something. And by the end of the month, I would select one lucky winner, and I'll reach out to you so that I'll send over this book to you. I have already sent over our last month giveaway to our lucky member, Lawrence. And thank you for him to give me a good testimonial. And I hope that I can continue to serve you guys for many, many more periods. Okay. I'll go to the Q&A first before ending it with a short announcement. Right. Let me see if I can share this Q&A. I'll probably just read it out. Thank you, Roger and Chan, for some of your questions. I'll read out Roger's question first. Do you think that the Chinese investor who used to invest in foreign property will train their site at their backyard now, considering that Chinese property value have dropped to attractive valuation level? Second question is, China still holds the largest middle class in the globe. Wouldn't that be a real estate opportunity for the Chinese investor? Okay, so I think most of the investor, right? So people who don't really need a house and is just buying for investment. Most Chinese investor, they want to diversify away from China, right? And I think they recognize the risk of still just living in a developing nation. I think the mentality is very similar to us as Malaysian investor, right? We can invest, we love to invest in our own country, but it reach a point where we would want to invest something outside as well, just as a safety net and as a protection. So I would say Chinese investors who are able to afford to invest in foreign property outside of China, I think they will be less reluctant to spend a lot of money investing in Chinese property, regardless of how big of a crash that it might have. Of course, that's just on my own view. But if you're talking about people who are buying for homestay, for their own stay, and for their own usage. The last statistic that I read across is that China home ownership is already around 80 to close to 90% of home ownership. So most people have their own home. And mainly because for the many years of one-child policy, you end up having two sets of parents being able to help the younger family, the husband and wife, to buy a house. So two sets of parents is able to help out for the newly couple to help to own a house. So most of the, I would say, middle class Chinese people, they are already homeowners. So the problem is they have too much of a supply issue, which lead to the crackdown, which leads to President Xi Jinping saying that property and houses is for staying, not for speculation. And this is a key thing that I think he wants to restructure the entire industry, where it's more focused on creating affordable housing for people, right? Going towards the Singapore HDB model, and then having a smaller private property market for those who have access, who want to spend more on housing. And this whole restructuring is their vision, but I think it will take a very, very long time to change that. Just look, in Singapore as a small city, how long does it take for the HDB program to fully take shape and to become like a necessity of the society? And then from there, Singapore developed their private property sector, right? I think it will take much longer in China. So that being said, meaning that I'm still not very optimistic about Chinese property at this point. Thank you for the question. Next one is Chan. Chan is asking, what are the Chinese big tech doing about generative AI? Alibaba and Tencent. So I would say these two companies and ByteDance are the ones mainly working on it, and Baidu mainly working on it. I haven't studied too much on it, but the only key thing that I read is they have been halting NVIDIA AI chips. So they have been stockpiling NVIDIA AI chips for a long time, just for their future effort. But with the US sanction right now, I would think that whatever that they are developing, it will still be quite how do I phrase it? It would still be much to a smaller magnitude compared to what the US firms are doing. Plus, I feel there's just a lot of hype in AI generally right now. And the investors community, if we look, the global investor community as a whole is still mainly US investors. So they are going crazy about AI right now. And most of them will still be focusing on looking at US AI stocks rather than looking at Chinese AI stocks. But that's a good question. I'll probably spend a little bit time to understand on what they're doing. My understanding is the company that's doing the most is actually Baidu. That's doing the most on this area. I'll find out a little bit more, and maybe I'll do a post on our Facebook group or on our website on this section. Thank you for the question, Chan. Next one, Martin, is what is your view on Chinese property stock? I think we mentioned that a little bit just now. I'm still basically not that optimistic about it. I think there are a lot of spillover effect, especially to the banking sector. that if you are a bank giving out so much loan to all this property that could be underwater or not even able to be completed in time, to be completed at all, I think there's a huge problem for the banks. We already see a lot of the shadow banking side of the institution succumbing to the default rate, and they themselves are defaulting now. So after the property company, we see the property companies defaulting. Then we see the shadow banking companies defaulting right now at this moment. The next step would be the investment houses and the property and the banks themselves. So I don't know how deep of a cascading effect it will have, but it's something that I will avoid completely, I think, at the moment. CK, thank you for your question. What is your view on the commercial real estate in China right now? Do you think that they will suffer the same fate as US counterparts, and any spillover effect to strong Hong Kong developers with mainland exposure? Okay, so CK, this I will be honest, this question I need some time to think about. As a whole, I'm not very optimistic about the entire market. But if you want me to zoom in on this particular set of commercial real estate in China and Hong Kong developers, give me a few days to study up, and I'll probably do a post on our Facebook group. Back to you. Thank you. And Eugene. Hi, Eugene. Nice to see you again. Hi, Stanley. Any views in general on JD.com, Pinduoduo, and Ping An? Thanks. Yeah. So I think Pinduoduo has been doing a lot of right things in the last few years. And they have successfully expanded to the US. And Pinduoduo basically, they came out because Alibaba and JD was trying to crack down on counterfeit and the cheap stuff on their platform. And so all the cheap goods have to go to Pinduoduo, and Pinduoduo was created and grow extremely fast. With the economy more in uncertainty, I would actually say the demand for things on Pinduoduo would be more resilient. But generally, I would say that I'm quite optimistic on all of them, given that the infrastructure is already built up, especially for JD.com, and for Pinduoduo, and e-commerce, I think will continue to do well even in a recession environment. Ping An, I would say Ping An, the main issue for them is also the exposure to the property sector through their insurance arm, their insurance investment, and also through their outside investment. They have quite a bit of exposure to the property sector. So unless the property sector is resolved, the issue there is resolved, I think there will still be an overhang on Ping An. So that's roughly it. So their fortune, sadly, is tag on to the property sector as well at the moment, I feel. Okay, Chan, what is your view on, give me a minute, what's your view on EV stocks like BYD and XPeng? Yeah, that's interesting. Okay, so when we were there in China, I would say that there's actually many Chinese brands, but the EV side mostly that I saw on the road will be BYD and NIO, actually, at least in Shanghai, and of course Tesla. I haven't really seen any Xiaopeng vehicles. That's interesting. I don't think I noticed any Xiaopeng vehicles, but definitely see a lot of BYDs and also NIO. I am still quite optimistic on them, but I would say that of all the EVs in EV brands, I am still leaning more towards BYD lah. Mainly that the products that they produce are more mass market. Plus they have already gone international and show that they can expand overseas, and their products are generally accepted and in overseas market. So BYD, I think, will be interesting. But sadly, this is a stock that, because of the Buffett effect, is always at a high valuation. And also the other one would be NIO, I would say. Of all the EV stocks, I would say these two are most interesting to me. The rest, I don't know. At least they give me the sense that they are still very much in the startup stage. And you know me, I'm a very risk-averse person, so so I try to look for more established players that have more or less stood the test that they are here to stay. And these are two that I feel has the most chance of survival. Okay, thank you. And next question comes from Freeman. In your opinion, what will be the catalyst for the main major tech firms to rebound their stock price since they have at the all-time low for a long time? Great question, Freeman. I like this one. My view is a little bit maybe different from most people. My view is actually has nothing to do with these tech companies, because I feel that over the last few years, the decline in Chinese stocks is also not so much to do with what's happening in themselves, but rather just the sentiment among investors about Chinese stocks and Chinese companies. And in the stock market world, the group of investors that's holding the most power and funds is still the US funds, right? No matter how we want to look at it, they are the biggest funds. Mutual funds, unit trusts, ETF, they are the big guys that control all the funds and decide where to invest. So with the negative perception on China right now from the US side, both retail and also institutional, I think as long as they have this China is a threat mentality, I think it's very hard for us to see significant rebound in the stock price. But that doesn't mean that I would, not invest in China at all. Because one thing is we don't know when this sentiment will change, right? And to me, these stocks are very, very undervalued at the moment. And if we have the time to wait it out, and I don't mind to invest and wait it out. But when will that happen? Excuse me. When will that happen? I really cannot tell. It really have to do more with the US election and the US new policy after the election, rather than what's happening in China, right? So that's my view. And Eugene, your question is, any view on the announcement made at the China 2 session this week? The stock market reaction appear quite muted and depressed, resulting from the announcement. To be honest, I haven't looked into it very detailed because I have been away. So I'll look through that again, and I'll give you guys an update, either through email or through the Facebook group. CK, another question from you. Any observation of strong gold or jewelry demand during your trip? No, not really. But at least I mostly just go through the shopping malls. Of course, the major luxury brands as well. It was never very crowded, to be honest. Overall, Shanghai just gave me a feel that it's quite muted, especially compared to Singapore. When you see how bustling Singapore is, it's a little bit underwhelming when I'm in Shanghai, to be honest. And I guess the strongest indication for you is just looking at the iPhone sales that they just announced a 24% drop on iPhone sales in China. And most major brands saw a drop as well. Only Huawei saw an increase in their sales. So I would say generally I would be a little bit cautious on looking at luxury guys. I'm also starting up on LVMH and also Hermes, looking through it. And Hermes, interestingly, more than close to 50% of their sales is coming from China. They don't disclose it in particularly as China, but they lump it as Asia Pacific and Japan, right? So with Japan taken out, I will assume Asia Pacific mostly is coming from demand from China, and that takes up close to half of their revenue, which is very interesting. So I would track the sales of Hermes for the next few quarters to see if there's going to drop in demand on the Chinese side. Yep. Thank you for the comment, CK. Also, on your experience when you are in China as well. Yep. Yeah, that's my experience as well. It feels quite quiet, even for a big city like Shanghai, and it took me a little bit by surprise. Okay. Good. I hope we have a good discussion today on the stocks. I just, before you guys go, I just have a short announcement to make. Actually, I have when I return and over the past few weeks during Chinese New Year and before, I have been talking with iFAST Global Market in Malaysia, and I have actually decided that I'll be joining them, iFAST Global Market Malaysia, as one of their financial advisor, because for a long time I have been looking for a platform that allows me to really become a financial advisor, but on my own terms, right? Because most of the banks that I talk to or other financial platforms that allow you to join them as financial agents, they are mostly always very sales focused and asking you to sell unit trusts, sell insurance. That's not really what I want to do. I have in my mind, I hope to be more of a wealth planner for everyone. And my approach is to have a candid discussion, to understand with everyone that I talk to what exactly is your objective of earning all this money and building all this wealth and having a target. What exactly is it used for, right? And to plan out something and reverse engineer and plan out something holistically and transparently, letting you know what exactly is my fees on that, on what I do, what are my deliverables throughout across everything from cash management, your bonds, stocks, your insurance, your will, or even creating a discretionary portfolio for you. So I finally found that iFAST allows me to do that, and they have the platform that allows me to do that. And I have found a team in Johor that is supportive when I told them that this is my approach that I want to go, rather than just doing it a typical style of just pushing unit trust and selling the unit trust that have the most highest commission. That doesn't appeal to me, and I don't think that should appeal to you as well. And so I'm in the process of onboarding with them, and so that's just an announcement to let you guys know. And if you feel that you want to be on this journey with me together, or to help for me to help you look into your wealth goal and financial goals, I love to set up a private Zoom call with you to discuss. I have already have a discussion with a few of our members already. But if this is something for you guys, you can WhatsApp me at my number here. 9422-8103, my Singapore WhatsApp. And I love to set up a one-on-one Zoom call with you guys. And it is not only for Malaysia clients as well, even for Singapore clients, that's fine, because as you know, iFast is a Singapore company, and we are able to help you link up with creating both Malaysia accounts and also Singapore accounts as well. So let me know. And Eugene, good question on how my iFast role will conflict with VIA Club matters. So VIA Club would still mainly be content generation, right? So the content I'm giving you guys would still be this, and mostly would still be focusing on ETF or stocks. It wouldn't interfere. I would definitely not, I would say, I would not be just promoting iFast funds on this platform. That's not my intention. My intention is to create the best possible content for you guys. And I might look at whatever is available on the iFast platform, but more complementary to you guys. But for onboarding, for onboarding clients to iFast, my plan is really to have this journey with you guys to create a more holistic wealth planning. Because previously in Singapore, I have also worked for a multifamily office, and I just see the way that, you know, the ultra rich, how they manage their wealth versus the rest of us. And I feel that, you know, that level of services, that level of access for them and planning for them should be available for everyone as well. So I'm trying to duplicate what I learned in the past on wealth planning for ultra rich and a more comprehensive wealth planning for everyone, and try to implement it for you guys, instead of the usual practices that is practiced in the industry right now, which is just pushing in insurance and pushing unit trust with no regards to how it groups together in your entire portfolio and in your wealth objective. That's generally my plan, right? Okay. Oh yeah, Eugene, you point out a good point that if I will see any restriction, but my discussion with them is that there's no restriction on what I want to share. But of course, I will not be bashing their products or or funds that they want to push. But I'm free to give my own opinion on interesting things that I found anywhere in the market, right? But the things that might change would be I might utilize their platform a little bit more. So just as a way for me to research a little bit more and also gain access to some, especially on the bond side, that they have a bond market that is more easable, searchable for me to showcase to you guys. Okay, so that's roughly it. Thank you so much. If you want to reach out to me, you know, you can WhatsApp me anytime. I love to have a chat. And thank you so much for spending an hour of your evening with me. I hope you enjoy this session. And I love sharing all these things with you guys. Thank you so much. Until we meet again, invest safely.